We're talking about Cara Operations today, a Canadian restaurant company with several brands. Very similar to MTY Foods, although that's more of a royalty company. This is royalty and ownership, probably more ownership than royalty. Very good brands. If you're Canadian, you'll recognize most of these brands, if not all of them. I've certainly recognized every single one of them. And let's talk about a few of them right off the top. So Swiss Chalet, Harvey's. I think Harvey's, everybody's been to that if you're a hamburger fan, and I quite like actually Swiss Chalet. Then some of the medium dining, I don't know, medium casual, something like that, would be maybe an East Side Mario's, Montana's, maybe some of these the prime pubs, which would be like a Finn McCool's, a Kelsey's, a Casey's, that kind of name. Perhaps a little bit higher end would be a Milestones, which is quite nice actually. Not super high end, but a little bit more than casual. Couple other brands that they've recently gotten into is New York Fries, which is basically in a food court, but good fries. The Landing Group, that's kind of in the same category, I would say, as a Milestones. A little bit nicer in my personal opinion. I quite like it. There's several of them popping up in Toronto now, and the Toronto and surrounding area. Certainly has room for growth because it's only in the Toronto area. So tons of room for growth, I think, for the Landing Group. And recently merged with the Keg. And the Keg's been quite a good story in and of itself. Been a good stock, good royalty company. So they merged with the Keg, and I think that's one of a really good brand, growing brand, pretty standard, good steakhouse that people would go to maybe on a business trip, maybe just on the weekend, or even during the week if you're so inclined. But good brands. Okay, so great brands is a good start, but why else do we like the stock? And we certainly need to look at our valuation model. And let's flip over to that right now. Okay, here's our valuation model. And as you see here, focus in on this top bar graph, and you'll see 4 years of history. Now, this company's actually been around since 1880s. It was a newspaper delivery service and food services for railroads. So they come by and buy a newspaper from Cara and get some food as well. Now it's gone public, back to private, and public again. I don't even know how many times, but I know recently it's gone public again. So it was private probably about just over 2 years ago. And it's public again. Stock hasn't done that great, although acting much better recently. So what we see in our return on invested capital data is that it's improving. So it went from 9% to 15 to 16 to now to 20. So that's always a good sign for us. We always like to see improving return on invested capital. We also see a pretty good valuation. Right now it's trading at about $27 Canadian, and our estimated value based on this scenario is $46. So that's a pretty good upside. Maybe 46 might be a bit high, and maybe I think maybe our growth assumption might be just a little bit too high. But the point is, there's some room for error. So good valuation. Valuation's always difficult, but if you get a good valuation or a decent valuation with a good quality company, that's usually a good formula for success. Let's talk about the quarter. Here you see some of the stats on the quarter. Q4 same-store sales were up 2.5%, which I don't think is going to blow anybody out of the water, but it's okay. It's respectable. It is a really important measure because same-store sales just says you're getting more out of what you already have. You don't have to put in more capital. You just you get more sales, which 9 times out of 10 flows right to the bottom line, so more cash flow without having to put up more capital. So that's always a key measure in any retail type environment. Total system sales are up 20%, or 20.9. That could be a little bit misleading with new stores coming in and acquisitions and so forth and so on. So that's, I don't put too much weight in that, but it's interesting that they're growing. It's good. Opened 56 new stores. I think that's great. Increase the dividend by 5%. The dividend's yielding about 1.5% right now, so not huge, but it's growing. And often we find with dividend companies, if the yield is low to begin with, but if you buy now, the dividend keeps increasing, that yield keeps going up. It's a very good way to build a dividend portfolio and a pretty good dividend income. As we said, they've added the Keg restaurant to their line as well through a merger. So we think it's a great quarter, a decent quarter. Good company though, and a good valuation, great brands. Overall, great idea.